Happy New Year, everybody! No noise. Supposed to be. Supposed to be a celebration as the market started off this year, January 3rd, 2012, in a celebratory mood. Markets really are kind of trying to look at the glass half full as opposed to half empty after last year's long route to zero. The S&P 500 started at 1257.60 and ended at 1257.46. So basically no return last year after having a series of ups and downs, all to get back to where it began. They say a roller coaster ride is the most exciting because you got the thrills of the ups and downs and the fast turns, but for most investors last year it was anything but. We're hopeful that this year does a little bit better, and with these Money Talks videocasts, we're going to try to get you updated more often and more frequently and go for once a week, hopefully the beginning or middle of the week, with our audio podcast still going to happen on Fridays the next week on Wall Street. So stay tuned regularly as we try to update these things. But what we saw in the second half of the year, from August through December, was a series of lower highs and higher lows, forming this pennant formation. And these are trend-ending patterns. As they compress down in this narrow compression, markets generally bust one way or another, really deep there. But we felt that the markets were probably going to bust to the upside for several reasons. One is we don't think the Europeans are ready to let the euro fall apart quite yet. It may happen down the road, but about a week and a half ago, right before the Christmas holiday, December 21st or 22nd, the ECB, European Central Bank, allowed for their constituent banks, the banks all across Europe, to get 3-year loans at a 1% interest rate on any debt that they could supply them. Well, that kind of circumvents the Germans' objection to the ECB, the European Central Bank, from buying the sovereign debt of countries like Portugal, Italy, Spain, and Greece. But now what can happen, much like our quantitative easing program that was going on 1 year ago, exactly 1 year ago, when our markets rallied around 25% from November 1st through the end of April, the banks can go out and buy the debt, buy the sovereign debt, and then use that to give to the ECB. They'll borrow the money at 1. Some of these Italian bonds are trading around 6%, and they make money on the spread, and then they sell it to them at a profit, so they repair their own balance sheets, and they fund the debt of the sovereign nations. Now that sounds very complicated, but what that means is that for now, I think that this debt problem got kicked down the road once again. Much like our quantitative easing, when the market rallied quite a bit, after the rally was over and after the quantitative easing ended, our markets tailed off and went down from April through August, or really bottoming out in early October. So that might happen in the second half of the year, but for the first half of the year, not only seasonally is this a good time of the year, generally January, February, March, pretty good months, but after this, again, compression, what we saw today was the breakout to the upside. Can it be false? Sure it can. That's why we use at Pacific Financial Planners stop losses and protection and exit strategies on every position we ever own. You should too. If not, call us 800-449-9501 for more information in terms of how to better protect your portfolio, especially in light of these volatile times. But we do think that the market has a good chance to continue this uptrend that just started relatively today, celebration from New Year's, and go for a little bit longer here as we get into the winter, into the spring months. So we've seen some of the leadership in the markets is the United States, the Dow Jones, the bigger companies. We're seeing value and dividend-paying stocks do well. Healthcare, biotech seeming to do well. So we're going to continue with our basically overweight investment strategy, which is different than what most people are. Of the last 35 weeks of the year last year, people were pulling money out of equities, adding to fixed income. We think that trend will reverse. The profitable investors, they'll reverse that a little quicker, and you can benefit yourself by making those changes shortly as well. But again, use protection. So we'll try to update these on a regular basis. If you've got any question, call us toll free, 800-449-9501. Best wishes for a happy and blessed new year to all of you. But we're looking for the first half of the year to run back up not only to the 2011 highs, but if we can get those levels, we might go all the way back to the 2007 highs, which coincide with the March of 2000 highs, which is about 25% higher from where we closed the year 2011. So we're looking forward to that. We think it'll happen. If it's going to happen, it's going to happen in the first half of the year. Stay tuned for more with me, Jerry Slusiewicz, on these Money Talks videocasts for more information.